Hello, I'm Tony Kay. Welcome to today's Advisor Q&A. And I'm joined in the studio here with three guests of mine. Robert Gottliebsen, who probably needs no introduction, but Robert's one of our financial commentators. Cameron Cusher, Head of Research for RP Data CoreLogic. And Bruce Brammall, Financial Advisor and regular commentator for Eureka Report. Thanks everyone for coming into the studio.
Pleasure.
Now, I picked a bit of a controversial topic today, gentlemen. Is the property market set to burst? A lot of people are wondering, is it or isn't it? Now, I thought I'd throw that open to you to start with, Cameron, just to give us a general overview of where the market is at the moment and what your views are.
Well, more generally, when you look at the market, it's still pretty strong, but it's largely a Sydney and Melbourne phenomena, as it has been for the last 4.5 years almost now. Over the last 12 months, property prices are up about 10% in Sydney, up about 9% in Melbourne. They're starting to pick up in some other areas. So Hobart, for example, has seen values rise by almost 9%. Canberra values are up 9%. But when you look at other parts of the country, so from their peak, property prices are down more than 10% in both Perth and Darwin. Adelaide's seen a bit of a pickup in growth recently, Brisbane not so much. So not really a lot of growth over recent years outside of Sydney and Melbourne. Some signs that some of the markets might be picking up a little bit. I guess the other thing we're starting to see is a fairly sizable divergence between the performance of houses and units. Houses are still growing very strongly, but we've got a record high supply of new units, both under construction and coming up for completion. And we're starting to see the performance of those two markets head in opposite directions. So in Melbourne, Brisbane and Canberra, for example, unit prices are growing at less than half the rate of houses. It's not so much an issue arising in Sydney, and I think the main reason for that in Sydney is that for a lot of people, the unit's really the only option to enter into the market. When you think of house prices up around $900,000 for a median unit price of around $650,000 is really the only option for a lot of people. So generally speaking, the market's still growing fairly strongly, not as strong as it was 12 months ago, but obviously low interest rates are still encouraging a lot of people to both buy property but also invest in the housing market.
Yep. Bob, did you want to cut in?
I agree with what you said, but let's just talk the apartment market for a moment. And there's some quite big differences between Melbourne and Sydney. Remember that the big driver of all these apartments that are going up has been the Chinese and Asian buyers, and they're having trouble settling. And you see a bit of a difference between Melbourne and Sydney. In Sydney, I exaggerate, but it's a one-man show. Harry Triguboff and Meriton dominate the market. And basically what Harry says in the apartment market is what happens. And the Chinese and Asians can't settle. In some cases, he's actually financing them through. So he's trying to avoid a big rush. And as long as he keeps that up, then I don't think that apartment market in Sydney will collapse. In Melbourne, they don't have a Triguboff. There's no Triguboff there at all. It's all over the shop. And the great risk there is that if too many Asians don't settle and the banks or the financiers pull the plug on a major developer, the place will get into real trouble. There's a lot of work being done, and I'm talking to some of the people doing this work, in trying to actually, if the Asians don't settle, how can we handle it? Can we defer it a bit further out so we can get someone to come in? And there's quite a few people who like to lend 10 and 15% to some of these troubled people working in that area. But the big risk, I think, is a collapse in either Brisbane or Melbourne of an apartment developer, and then that will spread, because it's quite true. The housing market is different to the apartment market, but if you've got a big crunch in apartments in one city like at Melbourne, it would certainly affect the housing market to some degree.
Yeah, it's a bit of a worry. Is that something that you're seeing in your data, Cameron?
It's certainly something that we worry about. I mean, if you look at Melbourne and Brisbane, for example, Sydney's been approving more units than houses for the last 20 years. And there's some geographic reasons for that. There's not a lot of land. There's a lot of national park and water surrounding Sydney, so they can only spread so far. Melbourne and Brisbane don't really have those same geographic constraints. You could do urban sprawl for hundreds of kilometres, but the last 36 months we've been seeing more units than houses being approved in those areas. And if we look over the next 24 months, if everything that's approved for construction and set to be completed over the next 24 months is built, in Brisbane the overall supply of units will increase by about 25%. In Melbourne, it's going to increase by about 18%. So that's really unheralded. And as we said, a lot of it's being funded by or being driven by people from offshore buying these properties. And if they have some trouble settling, that puts pressure on the developers. But the other thing it will do is when they ultimately sell that property, they're going to have to sell it at a discount. And that's going to drag down the price of all those properties in that building. So these people are going to lose equity straight away. And at the moment, we're already finding that when we get the valuations coming through of off-the-plan units, about 40% of them in Melbourne and in Brisbane are actually below the original contract price. Now, that's not a big issue if it's only, say, $5,000 or $10,000 below, because people are putting down a $10,000, $20,000 deposit. They won't walk away from that. The issue will be when it starts becoming $50,000 or $100,000 below that contract price. People will say, yes, I could get sued by the developer, but really are they going to chase everyone that's not going to settle? I'm only going to lose $10,000 if I walk away. It's a lot better than losing $50,000 or $100,000 if I settle on that property and I go into negative equity straight away.
I'm in Shanghai too. It's a long way to sit this week.
Exactly. Yeah.
Now, our listeners have sent in questions today. As usual, we'll try and get to as many of your questions as we can. We probably won't be able to answer all of them, but we'll do our best. The other thing is that we can't give you personal advice, so any questions that are trying to sort of get some personal advice, we'll probably give a more generalised response. So hope that's okay, but that's probably all we can do for today. So I'll start off, and again, listeners, forgive me, I will be doing a bit of reading of questions, so I'll do the best with my eyesight. I've got my glasses here, so we might put those on. So we'll get into the questions. First one is, it's from Ben. Ben says he's somewhat decided to sell his home. He was looking at buying an investment property for when he bought his house. He's in Sydney. He's thinking the units have done their dash. We've just been talking about that. What he's asking is it a good time to put it on the market?
Well, in Sydney at the moment, when we look at the number of new properties advertised for sale compared to a year ago, there's about 17% fewer new properties actually listed on the market at the moment. And this is one of the things that's really driving the strength in the Sydney housing market. Similar story in Melbourne, not to the same magnitude. There's about 6% fewer new listings than 12 months ago, and that's creating a sense of urgency in the market. I guess the point I would make is this growth phase has been running for almost 4.5 years, and that's an awfully long time for a growth phase in the housing market. So my advice would probably be to get that onto the market and sold sooner rather than later. The longer you wait, the bigger the risk that you run of getting to that point where the market's actually starting to tip over and really slow down. It's slowed a little bit, but it hasn't really slowed dramatically just yet.
Certainly, Ben, in regards to that, if you purchased a while ago the newer property that you're going to have and you've had some growth out of that, then holding the two properties for an extended period can be a bit of a it can be a stretch, but if the other one's unencumbered, then and you've got that extra bit of growth out of it, then don't be too greedy, I would think. And if you can lock in a price that you're particularly happy with at the moment, then that could be and probably is a better option before you get to a case of oversupply in a multitude of markets, if that's going to happen. And make sure you lock in a price that you're happy with now, rather than run the risk that you try to sell after the market's topped.
Yeah, which we definitely don't want to do if we can avoid it.
Picking tops and bottoms are just so hard in the residential property market. No one's very successful at doing that. So
Yeah, and it can be difficult, but we know at the moment it's strong, and we don't know how long that strength is going to last, and you can't try to predict with any great degree of accuracy exactly when that's going to be.
Yeah, and we were talking off camera, Cameron, there's a shortage of stock in some cities at the moment, so obviously that's underpinning demand.
there is in Sydney. That's a big driver of the market at the moment. There's so little new stock coming online at the moment. So there's obviously still a lot of demand out there. So people that are looking to buy really have this sense of urgency, and that's why we're seeing clearance rates back up above 80% in Sydney and in Melbourne, because there's just too many people wanting to buy, not enough people actually looking to sell. And I think one of the main reasons for that is it's actually hard to find value in the market now, because by the time you sell your property, settle that and then start looking for your next property, because there's not a lot out there, it could take you 12 months to find your next property. By the time you've bought, you're probably saying to yourself, I should have held on to that property for another 12 months and got the capital growth that was going to come through.
And there's another very unique situation occurring in our property market now. A great deal of the supply of property comes from people like me, if you like, who downsize and stuff like that. If my finances mean that I'm in the pension area, part pension, part investment, I'm not going to sell my house, not in a million years, because I will free up cash and that will reduce my pension. I'm not talking about me personally, I'm obviously, yeah. but it is, the lunatics in Canberra have gone and put the most stupid asset test in. That they obviously have got an IQ above 80. It's very, very bad. And it is designed so people don't sell their house, and they have to work to get on a full pension as fast as they can. So that means there'll be less stock coming from that older generation who wanted to buy an apartment. Who, by the way, also a little bit nervous about apartments because they haven't been performing as you put it out. So it's a double bunger. And but we are going to see less houses come on the market from downsizers. That will still happen, but particularly those that have got assets around about $800,000 or $600,000 or $700,000 or even $500,000, they don't want to get their pension reduced. So they can hang on to their house. If they've got any spare cash, make it bigger.
It's a big problem.
Stupid politicians don't understand game.
We'll load that one there. That was question one. We've got a whole lot to go. So we're going to move on to Kim's question. Kim's saying that major property players, I'm like Australian Super now. I'll just clarify that Australian Super don't invest directly into property per se. But Kim asked, they've been providing strong returns, albeit down from last financial year. How well protected are their portfolios from falls in Brisbane and Melbourne unit markets, and hence where is there likely to be a downturn or slide in terms of negative returns, low or negative returns?
If we're talking about Australian Super or the major industry funds or any major super fund, then they don't invest directly in residential property, as in going and buying houses. Yep. They may well buy the mortgages that sit behind the houses and have investments that are based on mortgage-backed securities, but they don't invest per se in property. They do it in residential property. They do in commercial property, in office blocks and Westfield and the like, but they don't have a particular link. So if we do have a fall off in unit prices, unit or house prices or residential property, it's less likely to have a direct impact on the returns of super funds because their investments are on the commercial side rather than the residential side.
Yep. Okay. Now, we've actually got another super question, Bruce, so I'll leave it over to you. This one is about someone contemplating buying a property inside their SMSF. There's been... we know that there's been some changes announced in the superannuation regime. Harry wants to know, should he really buy it inside his fund or outside his fund?
Very, very big question. It's going to depend on your circumstances. But let me make a few assessments or points. The rule that you're probably talking about, Harry, is the $1.6 million pension fund, the transfer to pension cap. And that's going to be the most that you can get into new pension as of the 1st of July next year. Now, if you've got an $800,000, $1 million fund or something like that, and you like the idea of residential property investment with or without a limited recourse borrowing arrangement, so gearing into it, then it can still make sense in order to help build your super. If you're aiming to get to 1.6 million or 1.5 or something, a geared property investment might, if property prices, do what they do over the longer term, assist in that. The differences between buying inside a self-managed super fund under an LRBA and buying outside of super in your personal name will depend on your tax situation and what it is that you're trying to achieve, how old you are, how long you've got until you're retiring, what your income is if it's outside of super. Outside of super, if you've got equity in other properties, you can borrow the whole 106%, including stamp duty, to purchase a property outside of super. Inside super, and outside of super, you can get tax deductions up to 49%, depending on your income. Inside super, you can only borrow 80%, maximum of 80%, depending on the lender. Some lenders will only do 70%. The tax deductions for your super fund, if it is in superannuation or accumulation phase, are obviously at 15% rather than what's available outside of super. So, Harry, it's something that Harry should get personal advice about, and somebody who will look at both what's inside his super fund and what he's trying to achieve there, and what's outside his super fund and his personal circumstances around that, whether the tax deductions available outside of super make sense for him, and how long he's got to, how long until retirement. But they're two very, very different questions. In a lot of cases, people have owned a lot of property or geared property outside of super and understand how property works. And it may well be that buying inside a self-managed super fund, geared or ungeared, can make sense. But it's a question that needs to be dealt with on a person-to-person basis. And sorry, Harry, we don't have enough of your details here, but a good financial advisor will be able to give you some assistance on making that decision.
Can I just say, what Bruce is absolutely right, that it's each person to make their decision, and they're complex decisions. But just on a preference, I prefer the property outside the super fund. I don't like the super funds geared. That doesn't mean the maths may be wrong. Just a personal preference.
Yep. Thanks, Bob. And thanks, Bruce, on that one. The next question is probably one for you, Cameron. It's from Simon. Simon lives in Melbourne, looking to build 2 side-by-side townhouses on a block. He's a bit worried about all the talk around the apartment squeeze. Yes. Is that going to translate down into things like, townhouses out in sort of still in Melbourne, a little bit further out of the city?
I actually think over the last few years, Simon, that townhouses have been really underdone. There's been such a focus on high-rise development, getting more density in our inner city areas. And because developers and councils have really been encouraged to build up, I don't think that there's been actually enough new townhouses being built. I think townhouses, to my mind, is a much better trade-off if you can't afford a house, rather than going to a unit. So I think a townhouse in an inner or middle ring suburb won't be as impacted by a downturn in the unit market, obviously, as other units are. And I think longer term, I also think that townhouses are much more livable and desirable than these high-rise units, particularly considering that a lot of them are very small in terms of their size. I've thought for some years that townhouses are something that we should be building more of, not less of.
I agree completely, Cameron. The performance or likely performance of the old quarter acre block that you're splitting into 2 or 3 to build townhouses is going to far more resemble what's going to happen in the housing market than in the high-rise, medium and high-rise or high-density developments. So what is being taken on here, though, is development risk and holding risk. If you're starting to do that process now, and you've got to get council approval, you've got to get a builder, you've got to get the approvals and get it through, 12 months, 18 months, you're looking to sell probably in 12 to 18 months, where is the property market going to be then? And that's the development risk. If you're doing this for the first time, is something that you need to pay particular attention to. Markets are strong now. What are they going to be like in 12 or 18 months?
Yeah, absolutely. Next question is from John in Canberra. John, a bit of a cheeky one here. If Sydney, Perth and Adelaide and Melbourne are set for a bit of a bath, I suppose we'd call it, do cities like Darwin, Newcastle, Alice Springs and other regional centres, are they also going to take a bath, or are they more in for a bit of light shower?
Well, Darwin's already taking a bath, so is most of the Northern Territory. Cities like Newcastle, I mean, remember that Newcastle is the sixth largest city in the country. It's bigger than Canberra, it's bigger than, Hobart, Darwin. It's bigger than a lot of other cities out there. Obviously, there's a lot of urban renewal going on in Newcastle, and it also offers quite a nice lifestyle at a much more affordable price point than Sydney. So we're actually finding at the moment markets like Newcastle and Wollongong are really going ahead in leaps and bounds, because people are realising that for a lower price than Sydney, you can live in these markets, particularly somewhere like Wollongong, and the commute back to Sydney is actually the same as if you're living in the western suburbs of Sydney. So some of the regional areas, we're definitely finding that particularly the coastal markets, there's demand coming back for those. And I think part of that is driven by the equity that people in places like Sydney and Melbourne have now looking for holiday or retirement homes. But I also think it's people getting squeezed out of these major population centres, looking for a more affordable area to live. And obviously, I think also businesses are now becoming much more flexible, with people working remotely, working from home, or maybe only coming into the office 1 or 2 days a week. And places like Newcastle, places like Wollongong, places like the Golden Sunshine Coast, places like the Surf Coast here in Victoria offer you a really nice lifestyle. They're still commutable back to the big city if you need to, and they offer a much more affordable price point to own a really nice home in a really nice location. So we do think that over the next few years there's going to be more demand for property in those types of areas.
You can add Geelong to that. You can add, and we're talking about Harry before. He's bought some land on the on the Gold Coast. You can commute from there, you see, to Brisbane. So that's possible. I just say one thing about that. I was at the Gold Coast recently, and they were telling me that 26,000 people every week go south to get to work.
Yeah.
The planes are packed, the airports are packed. You do need to think about your employment when you go into those sort of places.
And this is one of the reasons why Sydney and Melbourne have been so strong. 2/3 of all jobs are being created in Sydney and Melbourne. And housing affordability is not proving enough to encourage people to other parts of the country. I mean, Brisbane, Adelaide, Hobart are all a lot cheaper to live in than Sydney and Melbourne, but there's just no jobs there. And people just aren't going to take that risk at the moment of moving to another city like that if they can't guarantee themselves that they're going to find a job.
Yeah, there's the jobs, and there's also the whole issue of infrastructure around getting to and from those places, transport. Still a long way to go.
But remember, with Perth, Darwin and Brisbane, Queensland's a coal state. It's all about coal, and that's been down. It's now up. Darwin will be more and more a gas type. That's not quite right, but certainly WA and Perth is iron ore. So those sort of places have been hit by the mining investment slump. The commodity prices are starting to rise. There might be a bit more life coming in those places.
Yeah. Okay, on to the next question. This one is from Philip. Philip, similar sort of theme with some of those questions, but Philip's saying all property markets are regional and local, to greater and lesser degrees. Do you think the Sydney market surge will be followed over the next 5 years by a catch-up to some degree in Perth and Brisbane?
I do not think that that's going to happen. And I think it really comes back to what Bob was just saying about the jobs market. Unless those areas can really turn around their jobs markets, I think what we've seen over the last probably ever since the financial crisis is Sydney and Melbourne really establishing themselves a new premium above those other cities, because the population's a lot larger, the job creation has been much better, and unless that changes, I can't see Brisbane and Perth or any other capital city really going into the sort of surge that we've seen in growth in Sydney and Melbourne over the last few years?
I'm a little less strong in my belief in that. I'm a strong believer in reversion to mean, and over time, growth assets will revert to mean. And Brisbane is particularly a long way behind. It's never going to catch up, and it shouldn't catch up. There is a premium involved for Sydney and Melbourne, over Sydney over Melbourne, over Brisbane, over the other cities. But I think where we've got to with pricing for all property in Sydney and Melbourne over some of the smaller state capitals has to reduce over time, and there's an 80 or 90% difference up from, say, Brisbane to Sydney on median prices. That's not normal. That will not continue. I don't know how quickly the reversion to mean will happen. I'm not saying 1 or 2 years or 3 or 4 years. It could take 5 or 10 years. But yes, Sydney has a premium over Melbourne, over Brisbane, and so on down the chain. But the current premium, the extra 70, 80, 90% that you're paying has to crunch at some stage, or not crunch, but reduce at some stage.
Yeah, I don't necessarily think that will come through a surge in prices in Perth and Melbourne. I think that Perth and Brisbane. I think that will come from a slowdown in Sydney, maybe a moderate pickup in those markets. But I think that if you're going into a Brisbane housing market or a Perth housing market, thinking that there's going to be a big run on prices over the next 5-7 years, I don't think it's going to happen.
Okay. Thanks very much, gentlemen. That was a good discussion. The next question is from Liza. And Liza, it's a good point actually. A lot of the data is around auction clearance rates and auctions. She wants to know about private sales and even things that go off market. How closely are we able to track that type of data on the property market?
Well, ultimately, we do track all of that data. I think auctions get a very close attention, particularly in Sydney and Melbourne, because it's a timely indicator. You're finding out pretty much in real time how that market's performing. But the thing to remember, only about 30% of properties actually go to auction. So 70% of properties are sold by private sales or private treaty sales, or however you describe them. But what auctions do show is, particularly with the better priced inner city suburbs, they tend to reflect what's happening in those markets. And at the moment, last week, clearance rates were above 80% in both Sydney and Melbourne. So the auction market's very strong. The private sales markets are equally as strong. That's why we're seeing double-digit growth in Sydney. That's why we're seeing almost double-digit growth in Melbourne. But the auction markets, that's the sexy part of the market. That's the houses that everyone wants to know about. They're going to auction. They're not being sold by private sale. That's why that gets the attention. But if you look broadly across the market, it's very much reflecting what's happening in those auction markets. Inner city areas, 10 to 15 k's from the city, very strong. And then still strong as you move out, but not quite as strong in those housing markets as you move further away from the city.
And with auctions, Cameron, you sort of know immediately what's happened. You've got the data. There's an auction date, and it either sells at auction or it goes under another statistic. What we don't get out of private sales is the length of time that it took in order to sell, do we? So we know that it's sold, but we don't know whether it was on the market for 2 weeks or 2 months.
So at the moment, what we're finding in Sydney and Melbourne, it's taking about 37 days is the average time on market for a private treaty sale.
Okay.
So not overly long. In Hobart, it's about 45 days. Then most other capital cities, it's sitting at around 50 to 60 days. And then in Darwin and Perth, where obviously prices are falling quite sharply, you're seeing time on market around 70 to 80 days in those cities. And people are having to discount those properties fairly heavily in Perth and Darwin in order to actually get them sold at the moment. Discounting levels are up around 7 or 8% as well.
Like when in a strong market, the auction brings out buyers. They know that the house is for sale. You do need to be a little careful in a rising market not to sell too cheaply privately, because you might find that the buyers will actually take particularly if you've got a desirable property. If you've got an odd property that's difficult to sell, then that might be and you've got a buyer grab that person. But if it's a standard attractive property that there's plenty of buyers for in a rising market, put it on auction.
Yeah, yeah. And Melbourne's always been a strong auction market.
Yes, but I've been through, we've all been through times when the market's going down.
Yeah.
And if that's taking place, then I much more prefer the private sale where
Absolutely.
they've grabbed him, the person.
Even last year, so at the same time last year, I said we just had auction clearance rates above 80% in Melbourne and Sydney last week. Same time last year, we were getting auction clearance rates around 65%. So the market's really changed quite dramatically from where it was 12 months ago. Now, part of that is less supply. There's been 26% fewer auctions this year in Sydney than there was last year, about 12% fewer here in Melbourne. But also, we've obviously had another 2 interest rate cuts. That's dragged more people out of the woodwork to buy, and that's really strengthened the market. So there's a lot of factors at play, but certainly if you're in the inner city, got a highly desirable property in Sydney or Melbourne, the way to sell it at the moment would generally be auction.
Can I just add a completely side part of this? In Melbourne, there is a unique situation starting to develop. It'll take a year or two to come through, but the government has changed the rules for apartment development. And that means if you have not got an approval and you have to get the approval of these new rules, in effect it puts the price up about $100,000 of the cost, because you've got to make the apartments bigger. And that makes a better apartment, that's true. But also there's less on the block. There are more parklands and stuff like that, and they're doing both together. Now, we could well have an apartment run because a developer goes broke and all the things we've talked about before. But if the market is held together and the normal demand is allowed to come in and take these apartments, and that includes overseas demand, then suddenly the stock starts to run down, and the next apartment that has to be built, that includes suburbs as well, has got to be on different rules, and therefore the prices, there'll be no apartments built until the price goes up.
Yeah.
And so that change will underpin it. Of course, in the process, you might get a new government who change those rules. What state governments are like; they change as the parties change. But as it now stands, if there's a run on a Melbourne apartments and they start to go very cheaply, they could actually be quite good buying for those who are prepared to wait. Now, we haven't got a run at present, but it can happen.
Yeah, we don't know, but there's certainly some elements in there which are ones to watch. And actually, staying on the whole apartments area, another good question from Adrian. Adrian says, look, if there is a decline in new apartments, will that flow on to older apartments, as in, some of these Art Deco apartments and lovely things that we see in the inner cities? Is that going to flow on? And also, part two of that question is larger regional markets like Newcastle, are they going to be affected by the same sort of factors?
Well, the regional markets, I'll answer that second part of that question first, I guess. We're not seeing the same surge in unit supply in these regional markets. There's certainly more projects coming in places like Newcastle and Geelong, but nowhere near the magnitude that we're seeing in the capital cities. With regards to the first question, I guess it's hard to know exactly. What we kind of hypothesise about what's going to happen in the apartment market is that a lot of the new stock is being bought, yes, by overseas people, but also by investors. So ultimately, a lot of this stock is going to end up available for rent. Now, people will have a choice. People in older apartment buildings in suburban areas will go, I can stay where I am, I'll get a bigger floor plate, not as many people I'm sharing with, or I can move to these newer apartments, the apartment's going to be smaller, but it is going to be modern, it's going to have a gym, it's going to have a pool, it's going to be closer to the city. We think we might see some flight to quality from the rental market away from some of these older apartments to these newer apartments. So from an investor's perspective, that's something to think about. If the unit market does turn, particularly the inner city unit market, I actually think that the suburban style six-pack developments will be a little bit more sheltered from that downturn in the apartment market, because you're not sharing with 100, 200, 300 other people and people that might need to sell at a significant loss. It's probably more the stock that's your mum and dad investors that have held on to that property for 10, 15 years. It's not being driven by an influx of people that are looking to sell now, having, just not been able to settle. It's a different type of product.
And I think the market in apartments will divide in a different way, as well as that. Your big one-bedroom, maybe two-bedroom apartments in Sydney, Meriton are using Airbnb, and they're being rented out to tourists coming through, and the tourist market is going up. In Melbourne, not nearly as organised as that, but they will. They'll get themselves organised because they can see you can actually rent these places. Now that means if you're living in the place, you're suddenly you've got a whole lot of tourists coming through all the time. It's a different type of accommodation. I know Meriton divided up and they handle it, but it'll be harder to do it in Melbourne because it's not a one-man show. It's lots and lots of people. But that is going to start to divide up what actually happens. You'll have your education apartments and your tourist apartments. That these are small one-bedroom places like that, and they'll tend to differentiate between the slightly larger apartments. I think that's right.
That's an interesting point to bring up, Bob. The whole disruptor element in the property market over time.
Can I tell you, a friend of mine's a young journalist, and I said, "Where are you living?" And he's living in a one-bedroom apartment with his wife. You see, and I said, "Oh, how are you managing? How are you managing that?" "Oh," he said, "it's all right." He said, "It's good. I'd spent 2 years in New York before this, and this is bigger." So what you're learning is that young people, are actually accepting these smaller apartments out of their lifestyle. They sleep in them, do a bit of cooking, but not much, and then they're out. So it's we look at them and say, "Oh, I couldn't live there," but it's a different lifestyle.
I think it's interesting though. Obviously, that's appealing when it's you and your wife. You throw a couple of kids into the mix. I don't think it's going to be quite as easy to live in some of these apartments.
He reckons he can get a kid in there, but I'm not sure that's right. Not two, one.
Yeah, I've got a bit of a long one from Julie here, but on first reading it makes she's got a good point here. Why has there been so much conflicting opinion for so long by analysts and commentators? So Julie's saying, you'll read something about oversupply of housing apartments, and then we're talking about undersupply because of increased immigration. So that's one thing. There's a risk of bank overexposure versus no risk of bank exposure due to owner liability. The Chinese money flows stopping versus starting. So there's a whole lot of, I suppose, conflicting views out there all the time. And Julie's sort of final point is this really just sort of people, I guess, talking up their own book in a way, in terms of what's happening in the sector?
Can I come on that? There's a lot of that, but look, there's some quite clear situations. There is going to be an oversupply of apartments in Melbourne and to some extent in Sydney. The real estate agents will say that's not right, but it is right. But migration, and you tell me the migration rate, and I'll tell you how long that'll last. Because if we keep bringing migrants in, and we've seen it's been coming down a little bit recently, and there's official figures, if that was to go up again, or if the tourist market keeps rising and there's Airbnb, that can change quite rapidly. So you suddenly see people saying, well, look, here I'm expecting a high migration rate, therefore I'm expecting a shortage at this point of time. And then you say, well, what about the bank exposure? Now, we had a really naughty statement the other day from the Reserve Bank, where they said, well, we're going to tell you the bank exposure to apartments. And they picked out the inner city of Melbourne and Sydney and Brisbane. And I think from memory, 38,000 apartments. There's 200,000 apartments going up in these places. And they were picking, and then they gave the bank exposure to those 38,000. It was the most scary thing, because if you multiply the thing by 5, it looks like the banks are terribly exposed. The answer is we don't really know the exposure. We don't think it's that huge in the actual Chinese buyers, but it might be. But there is quite a substantial exposure in the developers. So you've got these two areas of exposure. So when I say there's a big bank exposure, I could be talking about developers or I could be talking about Asian investors. You have to know and nobody really knows. And clearly the Reserve Bank is either concealing it or doesn't know. I suspect it's the latter.
Yeah, I think that's a good point. I think it basically comes back to the fact that some people have access to certain data, some people don't have access to other data, and for things like, number of foreigners buying property, there's no really authoritative source. We get the Foreign Investment Review Board report annually. They've said in the past that they haven't been funded well enough to accurately capture all of that data, so you don't know how much you can trust it. There's private sector research on that. So I think it really comes down to which data is available, which data a commentator has access to, and ultimately which data you believe as well.
And you know what I do? I actually talk to people in the industry, and and I rely on that.
Yes.
And so I guess you could talk. You're dead right. The data's not necessarily there. Actually, you've got some of the best data, but it's you do talk to people. Now Sydney's easy. You know exactly what's happening in Sydney because you only have to talk to one man. The other places are harder, and different people have different views, and a lot of it goes into what I think is going to happen in migration. Because if we start to ramp up migration again, I don't think it's something I'm going to do, but if we did, and those migrants start coming into Melbourne and Sydney, then you'll see this cheap accommodation taken up.
It'll absorb a lot of stock.
Yes.
Yeah. And as you say, Bob, I mean, the best way to find out what's going on in the market is to actually get out there and have a look for yourself, talk to people, go to auctions, see who's turning up at the auctions. There's nothing better.
That's a really good point. If you're going to buy an apartment or a house, really, I always say to people, look, don't wait till actually you're ready to do it. Go in there quite a few months earlier and let's see what value is. See what value is in an apartment. What does a one-bedroom apartment mean? What does a two-bedroom, a three-bedroom, or a six-pack, or whatever it might be? So you actually start to get a feel for the market and what value is, and that gives you a really good idea of what you could see. You'll see yourself what's happening.
Yeah. Well, I'm going to have to wind it up there, gentlemen. It's been a fast-flowing conversation on all sorts of different things. There's so much going on in the property market, as our listeners will know of already, and it's just been really fascinating to talk about the trends, the current dynamics in the market. So thanks again to, we'll work our way this way, Bruce Brammall, financial advisor and Eureka commentator, Cameron Cusher of RP Data CoreLogic, Bob Gottliebsen, again, who needs no introduction, but regular commentator for Eureka Report. Thanks very much for tuning in. I'm Tony Kay for a Eureka Report. Join us again next time.